Hello, this is Bill Moreland with Bank Reg Data. Today I'm going to spend a little bit of time talking about First and People's Bank and Trust in Russell, Kentucky. It is a small privately held bank. It's not publicly traded. It doesn't have a stock ticker. It's not a stock exchange that I'm aware of. Normally I don't spend much time talking about these banks publicly. But there's a couple things going on with this bank that I think they're in some serious trouble. And so I wanted to illustrate a couple of the ways that we review a bank and why this intersection of events is problematic for a bank like this. First thing we notice is total assets are shrinking. So they are shrinking the bank down. You see total loans is shrinking as well, 131, 131, 115, 97. So there's a couple problems with shrinking loans. Is that's shrinking income too, right? Net interest margin is going to be shrinking. So realistically, their income producing potential is going to be shrinking. The first problem we have that this bank is experiencing is their mark-to-market losses are 14% of their securities portfolio. However, it's 67% of their capital. So let's take a look at Tier 1 capital with these guys. And what you'll notice is they're a CBLR bank, Community Bank Leverage Ratio. They do not report risk-weighted assets. They only have Tier 1 capital. The only metric available for a bank like this, an 051 reporter, CBLR, is average assets. So their Tier 1 capital as a percent to average assets is down from the 17, 18% down here in the black. You see a little bit of that where they looked really well reserved. And then you see the number is a percentage is going down. And that's understanding that average assets is shrinking. So the denominator is shrinking, but what you see is this bank is burning capital. And the reason they're burning capital is they're losing money, right? So getting back to the mark-to-market losses, we already see that capital's going down. And the reason it's problematic for these guys is 44% of their assets are loans, 40% are securities, 6.5% cash. So the reason their mark-to-market losses are such a big deal is it's 40% of their book, their assets. So we go to securities data, we go to appreciation, depreciation. There's the 14%. So this is their mark-to-market loss on available for sale and held to maturity. You've got to look at both. Do not fall in the trap of just looking at AFS that gets marked to market. You got to look at the held to maturity too. This is not horrendous. I mean, it's worse than peers. Notice how the similar sized banks, their losses are coming down as time goes by and they cure, as well as their losses are coming down as a percentage. But notice as a percent of capital, this is 67% of their capital would be wiped out if they had true mark-to-market accounting. Silicon Valley Bank failed at 110. So realistically, anything above 40, 45, 50% of capital is very problematic and should be worried about from a counterparty risk perspective. If I go to liquidity and I look at core deposits, they're not losing much, but they are down. They're down from 200 pretty consistently to 189, 187. So they've lost some. The reason they haven't lost it all is deposit data essentially insured. And this is an estimate. These are not reported numbers. The FDIC has a calculation, but instead of being at 84, 82, 83%, they're upwards of 90, 89, 88%. So the people that are still keeping their money there as depositors, checking account holders, money market accounts, CDs, for the most part, are pretty well insured. So there may be some flight risk on deposits, but what do you worry about? You worry about mark-to-market loss. What's the second thing that you worry about? You worry about the bank having high delinquencies. So what we see here is their book is shrinking, right? Total loans are going down, 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 which we identified earlier. And their delinquencies are 22 to 25% of their loan book. And if you scroll down, you see these are their loans. The top one for them at $53 million, 54% of their book, and a 90-day past due plus non-accrual, which is non-performing loans, is almost 40. Is all other. One, it's very strange for a bank this size to have such an enormous amount of all other. Typically, it's very uncommon. So I click on all other, and we can see that that number had to have been a reclassification from other things. I'm wondering, I haven't looked at this, but I'm wondering if I can find it right. There's C&I, looks like a little bit of reclassification, and it looks like loans to individuals. There it is. So basically what's happening is they're lending to consumers through an intermediary, which I'm not a big fan of NDFIs, Non Depository Financial Institution loans. I'm a credit risk guy. I think it's crazy for a bank to dissociate the risk decision to a third party. But for whatever reason, the regulatory bodies believe that these are safer loans. Well, I can flat out tell you, I've managed risk. I worked for a company. I built their risk department. I left, and then I was reacquired through another merger a number of years later. And I went back into that exact same company, and everything that we had built 10 years earlier was different. I mean, completely, like piss poor. So just assuming that someone else that's managing that money is a credit intermediary, a consumer intermediary, small business lender, a consumer lender, whatever that third party intermediary is that you're lending the money to is going to continue to make good risk decisions is naive. Frankly, it's surprising the regulatory bodies wouldn't consider them to be higher risk, but for whatever reason, they're viewed as lower risk, especially if they have collateral. They may not have to hold as much reserves or capital against it. So we know that going back in time, that there was a reclassification to consumer, from consumer. We don't have a breakdown. These guys don't hit the threshold on the breakdown, but we know that historically they started to have some pretty high delinquencies right after the reclassification. We would not have known these were NDFIs. They were just been in all other NPLs. But if we go back to the total all other, there is a breakdown of munis, NDFIs, carry. So it's 52 million, 70 million, 69 million. So that's it. So we would have been able to ascertain that their all other NPLs were specifically coming from this particular portfolio. But they're actually starting in Q4 24 is a breakdown of this. So what you're basically looking here is they're running 40% delinquency rate on this portfolio. And are they taking charge-offs? Well, we don't have that at the NDFI level. That data is not available. But if I go back to the total all other, which we know the number is 96% or whatever, you'll see there is a charge-off. They're eating charge-offs to the tune of, 4, 5, 6, 15%. And you can see that big jump there when they reclassified them. This bank is bleeding charge-offs. So I don't understand how the loans are structured. They're structured to a third-party NDFI. They're a wholesale lender to this guy. This intermediary is clearly not doing a very good job of managing. So what you would expect is the yield from these guys would be enormous. And what you're seeing is, it's $376,000 is probably where that's coming from. We don't have a denominator on there to know, so we can't really tell what the yield is. But I can look at the yield on their total loans. This is their entire book, 4.5%. So even on their NDFIs, it's got to have a low wholesale rate to this, which makes no sense because their charge-offs are 4, 5, 6%, right? Sometimes 10. So this bank clearly is not making any money. I mean, you can come in and you can basically look, their net charge-offs are enormous, and it's all coming from that NDFI portfolio. Their reserves, asset quality, allowance, they look incredibly well reserved, but they're not. If you look at the coverage ratio, they basically have 19 cents of reserves for every dollar coming through in adjusted NPLs. So you look at this and you can't help but think that they're going to continue to take losses on this portfolio. And so do they have the ability to generate income to offset these losses? So I go to income and expense, pre-tax net operating income. Nah, they're not making any money. Are they setting aside provision to refill the allowance bucket? We did see allowance was stable. Provision is basically being refilled. But how are they refilling provision? Well, bank home, that's it. So this bank is not generating any income. Their mark-to-market losses alone would be enough for counterparty risk people to be worried about. Treasurers that have accounts or widows or big savers. But since they're very insured, that group seems to be a little bit more complacent. It's not hot money, possibly because it's in Russell, Kentucky. So there's not a huge amount of options, and they may or may not know to the extent of what is happening with this bank. But you can see where they ate $12 million in capital back in 2022 Q4 to go from 46 to 34. 2022 Q4 was 2022 Q4. I mean, so every dollar that they lose, in charge-offs is coming straight from capital. So I try not to be in the business of, although with Flagstar, I'm flat out saying I think Flagstar is in a lot of trouble. I think I'm not hunting and pecking for looking for people, but I think First and Peoples is in a really difficult situation right now. And it would not at all surprise me that they're trying to find a merger, an acquirer, but who would buy this, right? Who would buy this? And the flip to this is at some point they have to start raising capital, because 9.07% is not ridiculously low. I mean, there's some banks down here that you really need to look at. But as we've already established, they got $20 million of adjusted NPLs, and they got $16 million of mark-to-market losses. The intersection of those two combined is going to continue to put stress on their Tier 1 capital. As always, I appreciate your time. If you have any questions, feel free to reach out. Thank you.